Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Cut to the Chase. Now the much-awaited US CPI inflation release for March had a little bit for everyone. At a headline level, the 8.5% inflation reading was slightly higher than market expectations and was the highest print since the early 1980s. Now, it was energy and food prices that really drove the surge in the overall inflation number. Energy prices jumped 32% year on year, while food prices rose 8.8%, accounting for about half of the rise in inflation. In contrast, though, the rise in core inflation, or the inflation measure that excludes food and energy and focuses more on demand-led components, came in much more muted than expected, rising by 6.5% year on year, but only 0.3% higher relative to last month. Now, this slowing in core inflation was led by a fall in prices of durable goods as well as used cars, though other components like housing continued to rise. Now, you might very well question why we're getting into this deep dive on US inflation numbers, and there are two specific reasons for this. First is that while we don't expect one number alone to alter the Fed's rate hiking path, a point Fed Vice Chair nominee Brainard made again yesterday at a public appearance, it does support the case that a slowing of core inflation could take some pressure off the Fed to further accelerate rate hikes in the second half of this year. Second is the implication for bond yields, where the softer core inflation report does make a run towards 3% for the 10-year US government bond yield, somewhat less likely in the short term at least. Yesterday, we discussed how markets were already positioned in a one-sided manner towards higher bond yields and how the 10-year yield itself was running up against some pretty strong technical resistance in the 2.7 to 2.8% range. The fact that bond yields failed to break above this offers some reason to expect a pause for now, which could offer a breather, of course, to yield-sensitive asset classes like long-maturity bonds or even tech sector equities. Now, it was not all good news in markets though, and the worries this time were in oil. Now, in its monthly report, OPEC did cut its forecast to world oil demand growth, saying supply chain bottlenecks, COVID lockdowns in China, and the impact of higher commodity prices were all likely to contribute towards slower demand growth than previously expected. However, oil prices still jumped around 6% overnight, and this followed reports that EU ministers were still deliberating a possible embargo on Russian oil, OPEC itself warning that it would be impossible to replace potential supply losses from Russia, and Russia itself saying talks with Ukraine were at a dead end. Now, reports that Shanghai was selectively loosening some COVID measures for select residential communities was taken positively by regional equity markets, but they did add to concerns that oil demand growth could resume on the margin. Now, in our view, where oil goes from here will depend on a tussle between fundamentals and technicals. Short-term technicals, at least, argue WTI oil prices will be range-bound in the near term, with support around $95, resistance around $105. Fundamentals, though, are likely to dictate whether a breakout in either direction does occur, and specifically with how the conflict in eastern Ukraine pans out, and whether the EU takes any steps towards a Russian oil ban, likely to be the two main drivers. For energy sector equities or currencies, though, as we've said before, we'd be less concerned about any downside risk to oil, given we still see plenty of room to catch up just with the current level of oil prices. So pause ahead in 10-year yields and a range-bound oil price short-term are the two takeaways for today. But as always, if you enjoy this podcast, please don't forget to rate and like it. Thanks again for listening. We wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.